Getting into retirement planning and some of the basics that we want to cover here, we don't get too in-depth, but there are a few topics that we want to cover so you have some more awareness. We'd encourage you to go meet with a financial professional to go through this stuff in more detail. Working through some of the types of retirement plans that are available, 401ks are available to the majority of workers that are out there. 401ks at this time, you can contribute $23,000 per year, and if you're over 50, you can invest up to $30,000. The great thing about 401ks is that they typically are offered by employers who also provide matching. So say you contribute 10% of your income to your 401k, and then maybe your employer has an extra 5% match. So if you're contributing the full 10%, then what's being added to your 401k is really 15% of your income due to the match. Now, those types of programs are very generous, and they can help you build your 401k up more quickly. And a lot of professionals will recommend contributing to the max limits if you can, because then you'll get the full match and earn the most interest over time. Now, not everybody can contribute up to the limit, but earlier on in your career, you want to build this as quickly as possible so that as you get older and you have larger expenses, if you can't contribute as much, then the interest can compound and you can continue to build a nice retirement for yourself. Now, 401ks typically are limited to certain types of investments. There are different types of funds that you can invest in with a 401k, but it's typically not stocks. A lot of product offerings are not going to allow you to invest directly in stocks because they're considered risky and they want to make sure that you have this income for your future. Similar to a 401k, there's a 403b, which is essentially a tax-sheltered annuity. It works similar to a 401k, but these are tax-exempt when making withdrawals. These are typically limited to public employees like public school teachers, but they can also apply to employees of some tax-exempt organizations. Then there's the IRA, which is an individual retirement account. This is something that you're contributing to a lot of times with your employer. You can make contributions, but sometimes they don't have that additional matching like they do with the 401ks. The reason you would move to an IRA over a 401k is so that you can have more control over your investments. You can invest in stocks if you have an IRA, but the contribution limits are a little bit lower than what you see with 401ks. Now, there are also two types of IRAs that you can choose from. There's a traditional IRA, which uses pre-tax contributions and is taxed when you withdraw the money. And then there's a Roth IRA, where you're contributing your after-tax income and you only have to pay taxes if you go over certain withdrawal thresholds. And we'll talk more about the differences with traditional and Roth in just a moment. Before we move on, I just wanted to share with you some of the other savings plans that are out there. There's a 457, which is a plan similar to a 401k, where the investments are made pre-tax. And then there's also thrift savings plans, which are again very similar to 401ks, but are typically offered to government employees and members of the military. Now, I wish I could go into more detail about these programs, but I'm more of the math guy. I don't have a ton of detail about these plans, so rather than say something wrong, I just advise you to go talk with a financial advisor, and they can give you more detail. Most of your employers should have hotlines that you can call to set up a free appointment. Probably one of the most confused topics is traditional versus Roth when it comes to your IRA or now your 401k. There's not really a straightforward answer for which is better overall. It really depends on market conditions and certain assumptions that you're making about taxes. If you're making contributions pre-tax, you're assuming that the taxes you're paying when you take that out are going to be less than what you pay today. So if you believe taxes are going to be less in the future, then you want to go the more traditional path. If you would rather use after-tax money to invest to avoid taxes on your earnings in the future, then you'd prefer the Roth path. Now, in this example, let's say at 40 years old, you get a one-time $200,000 bonus from work for a kickback on a product that you helped develop. Using that as the baseline and assuming you're contributing 100% to your retirement plan, would you rather pay taxes now based on your income tax rate, or defer taxes until you get to retirement and you're able to withdraw the money? In the Roth, you'll have an upfront tax bill of $66,000 if you have a 33% tax rate. So you're starting out at $134,000 versus a traditional plan where your initial tax bill is zero and you start out with the $200,000. Assuming you accumulate interest for 20 years, then withdraw a reoccurring amount for 30 years, as if it's an annuity. In the traditional plan, you'll certainly end up with more in your retirement account, but as you go to withdraw the money, you'll be hit with taxes. In the Roth plan, you can still get hit with taxes, but it's not as likely. Either way, your after-tax take-home is about the same. So in this instance, it's just a matter of, do you want to be worth more or do you want to pay less in taxes? Now, of course, this is a simplified example, but depending on contribution levels and having a different time period to accumulate the interest, the right decision for you could vary. As it relates to capital gains tax, for most assets that are held onto for more than 1 year, it can be anywhere from 0, 15, or 20% tax, depending on the asset type and the income that you made. Most investors in retirement try to withdraw less than the cap for 0%, but you also have to take Social Security payments into consideration, and if you withdraw too much, it can impact your payments, and you might end up receiving less or even having to pay back some of that if you're not careful. Now keep in mind that those rates are just for holdings of more than 1 year. For assets that you held on to for less than 1 year, typically you're subject to your income tax rate, which can be considerably higher. In terms of balancing retirement and Social Security, what you need to understand is that if you have a large pool of investments and you're drawing Social Security, you can only withdraw so much from your investments before you begin to take a penalty on your Social Security benefit. Now, eventually, you're going to hit a point where you don't get any Social Security or you have to pay it back because the withdrawals from your investments are so large that it nullifies the benefit. Now, what you see here is an individual with a $675,000 portfolio earning 8% a year. Now, as they make withdrawals, they'll pay a 15% capital gains tax on any investment earnings above $44,626 per year. That would mean that they receive about $52,594 per year. And over time, as those investments grow and their payments become larger, if the Social Security limits don't change, they're going to lose some of their Social Security benefit as their investment earnings surpass that upper limit. Now, depending on the income that you're making from Social Security, the limits start at $21,000 and go up to $56,000. So if your investments are making you above $56,000, an increase in income means losses to your Social Security benefit. Now, to me, this is kind of annoying because you earn the benefit by paying into the system your whole career, but that's beyond our control. So the point here just becomes recognizing that there is a penalty and not withdrawing more than the limits until your investments are making you above a threshold where losing all of your Social Security benefit would actually make sense. And if you think that you need that much money during your retirement, then you need to go meet with a financial planner to determine the best path forward. If you have large amounts of wealth, you already should have financial professionals that you're working with, but regardless, taxes and benefits need to be accounted for with retirement planning, and this is just something that most people never consider until they're ready to retire. Getting into mutual funds and hedge funds, what exactly are they? Well, in reality, they're all just funds. The word hedge came about later on, and hedging is just a strategy that most of them employ. Really, it's just a group of people that are pooling their assets together in order to exert more control over their investments. That way they can control certain outcomes a little more and make sure that they're getting returns for their capital. What you're typically doing when you're pooling your money together is you're buying shares in a fund, and then it's the fund that's using your money to invest in what they want. Now, doing so transfers the voting rights that would come from you owning the stock to the funds that are managing your investment. Now, that gives them power, and if you believe in your fund manager, then perhaps that's exactly what you want. The vast majority of folks aren't equipped to handle managing their portfolio, which is why these funds have been so successful over the years. So understand that most of the money behind them belongs to everyday folks like teachers, nurses, and tradespeople. Now, they get a bad rap because they're managed by these big firms on Wall Street, but they do exist in order to help out a lot of the middle class. So it's up to you whether or not you want to purchase their products. Most of you have employer-sponsored 401ks that are likely forcing you into certain mutual fund products. They aren't typically bad products, but you do have to pay attention to their performance and make sure you're putting your money in funds that are actually providing stable returns over time. It's a little like stock investing, and you really have to be careful which funds you choose and where you put your money because the losses are still possible. The last concept that I want to cover here is insurance. You can get insurance for some of these products, and there are insurance companies that are out there that can help you with this. Just like you would get insurance for your car or your boat or RV or something like that, you can get insurance for some of these financial products. And now it's a way to help you hedge your bets in case something goes wrong with your investments, and certainly that's something that you can talk to your broker about or reach out to your insurance agent. I'm sure they'll be happy to tell you what sort of products are available to you and who can offer them to you. Now keep in mind, most brokerage firm accounts are not FDIC insured like your checking account or your savings accounts. So if you're keeping money in a bank, your deposits are going to be FDIC insured up to $250,000 per account. But brokerages, certainly the stocks and the funds hold value, but in general, read the fine print and double check to see if they're offering any type of insurance on your deposits. Just make sure you're working with good investment firms, because if they go belly up, you can lose your money. Find yourself a good insurance agent and work with them so you can figure out what's right for you and your needs based on the level of investments that you're holding. Now, if you're sitting on a portfolio worth $2,000, then maybe this might not be something that you really need. But if you're investing $3 million, then yeah, go sit down and talk with financial advisors, financial planners, and insurance agents to figure out which are the right products for you.